Okay, let's talk about an alternative for financing your next vehicle. It's no secret that the majority of us finance when we purchase vehicles, and most of us are going to focus on payment rather than overall costs. Just to recap from earlier in the course, if you were to take a 60-month loan for $25,000 at 5%, your monthly payments would be $471.78. Your total cost, $28,306.80. This would make your true interest rate 13.2%. Now, if you were to do this just 3 times over the next 20 years, it would be $84,920.40 out of your pocket, gone forever. But what if there was a way for you to keep those funds and self-finance your vehicles? Would it help your financial future if you could keep an extra $84,000 in your account? What if between you and your spouse, you did this 10 times over the course of your life? That would mean $283,000 you would hold on to as opposed to giving it to car dealers and lenders. Let me show you what I mean. Now, in this scenario, I'm going to do a screen share because I have to read this. In this scenario, we have a 45-year-old male who's going to contribute $10,000 a year for 20 years into their cash value life insurance policy. I never said cash value life insurance was a great investment, but I will say it is probably the greatest financial tool. Let's show why. Now, if you have $10,000 a year over 20 years, you're going to contribute what? $200,000. Now, you're projected in the 20th year, as you can see in the last payment of $10,000, to have over $268,000. But where does the financing come in? Okay, well, let's look at this now. Same exact policy, except with some loans attached to it. Now, if you go down to year 7, you can see a minus $15,000. That's the net premium outlay. You borrow $25,000, but you still pay $10,000 into the policy, which you're going to do. You're going to continue to pay for your policy. But the net outlay is minus $15,000. Over the next 5 years, it's about a 5.2% interest rate there. You're going to pay back. You see the premiums went up to $15,664. That's the $10,000 premium there, plus $5,664 that you're paying back from the loan. And then you could see, and it pays for 5 years, and then it's back down to $10,000. The very next year after that $10,000 premium, you borrow $40,000 for another vehicle. Hey, you want a more expensive vehicle, you need an SUV or something, they cost more money. So it says minus $30,000. Why? Because you paid $10,000 in life insurance premium. We're going to do the same thing. We're going to pay it back over the next 5 years. So it's a little over $19,000. But look at this. At age 65, if you recall, on the policy with no loan, your cash value in that final year paying premiums was $268,474. Now, where you took the loan, it's $267,609. That's only an $865 difference. Now, let's look at the flip side of that. If you were to go to the car dealership and take out a loan, you would borrow $65,000 total, right? You have the $40,000 and the $25,000. At 5% interest rate in a 5-year loan, your monthly payments, all of that would add up to $73,597.80. Total cost. That means $65,000 of that is going to the dealerships, and $8,597.80 is going toward the lender. So my question is to you, would you rather be minus $865, or would you rather be minus $73,597? I think the answer is obvious. You have any questions on this, reach out. We're here to help. That's what we do. I'm your financial coach, Derek Nelson, and I will see you on the next one.